Investing in stocks can be a great way to create wealth and financial security, but it's important to make sure you're picking stocks and investing properly. With so much information out there, it can be overwhelming to know where to start. Fortunately, there are some smart strategies you can use to make sure you're picking the right stocks and investing properly. In this video, we'll go over 5 smart ways to pick stocks and invest properly. So before we get started, make sure you like, comment and subscribe to stay updated on our future videos. 1. Define your investment goals. When it comes to investing, having clear and well-defined goals can help you make better decisions. Before you even begin investing, take some time to consider your goals. Ask yourself questions such as, what do I want to accomplish with my investments? How long do I plan to keep the money invested? How much risk am I willing to take? Understanding what you want to achieve with your investments will help you decide which type of investments will be best for you. You may want to generate income from your investments, grow your wealth over time, or protect your savings from inflation. Your goals will also determine how much money you need to set aside for investing and how much risk you're willing to take. Make sure your goals are realistic and achievable. If you don't know where to start, speak to a financial advisor who can help you create an investment plan tailored to your needs. 2. Consider the risks. When it comes to investing in stocks, it's important to consider the risks associated with each investment you make. Investing in stocks carries a number of risks, including market risk, liquidity risk, inflation risk, and default risk. Market risk refers to the risk that the value of a stock will decline due to general market conditions. This can be caused by global economic events, geopolitical events, or industry-specific events. Market risk can affect even the most diversified portfolio and is difficult to predict or avoid. Liquidity risk refers to the risk that an investor may not be able to sell their stock due to a lack of buyers. This type of risk is usually associated with more illiquid stocks, such as those found in the micro-cap sector. Inflation risk is the risk that an investment's return may be eroded over time due to rising prices. This can be offset by investing in stocks that pay out dividends. Finally, there is default risk, which is the risk that a company may fail to make payments on its debt or other obligations. Default risk is typically associated with lower-rated bonds, such as junk bonds. Before investing in any stock, it's important to understand the risks associated with it and determine whether they are appropriate for your goals and risk tolerance. 3. Consider the fees. When it comes to investing, one of the most important factors to consider is fees. It can be tempting to go for the lowest fees, but it's important to take into account what those fees cover. Some brokerages may offer lower fees, but may not have the same level of services, research, or support that other firms provide. Additionally, some fees may be hidden, so be sure to read the fine print before you make any decisions. When researching a potential brokerage, make sure to ask about their fees and what they cover. Different brokers offer different services, so make sure you understand exactly what you're getting for your money. Researching the fees associated with different brokers will help you determine which is right for you. It's also important to consider transaction costs when buying and selling stocks. These are the costs associated with making trades, and they can add up quickly if you're trading often. Make sure you understand what these costs are and how they affect your bottom line before you start trading. 4. Diversify your portfolio. One of the most important steps in successful investing is diversification. This means that you should spread your investments across different asset classes, sectors, and geographies. Diversifying your portfolio can help to reduce risk, as you're not putting all of your eggs in one basket. You'll have a greater chance of generating returns, even if some investments don't perform as expected. When diversifying, consider different asset classes such as stocks, bonds, real estate, commodities, and mutual funds. You should also look into investing in different sectors and geographies. That way, if one sector or geographic region performs poorly, you may still have some investments that are doing well and providing returns. It's also important to maintain a balance between risk and reward when diversifying your portfolio. Consider your investment goals and risk tolerance when deciding how much risk you're willing to take. For example, if you're a conservative investor with a low risk tolerance, you might opt for a more conservative portfolio with fewer volatile assets. On the other hand, if you're looking for more aggressive returns, you could invest in more speculative assets. By taking the time to properly diversify your portfolio, you can increase your chances of success and minimize risk. With a carefully planned and balanced portfolio, you can maximize your potential for returns and be better prepared for any market shifts. 5. Set realistic expectations. Before you start investing, it's important to have realistic expectations about what you can expect to achieve. While there is always potential for growth with investments, it's important to understand that the stock market does not always go up. Make sure to consider both short-term and long-term goals when setting expectations, as different investment strategies are better suited for different goals. When setting realistic expectations, ask yourself questions like, what level of risk am I comfortable with? How much return do I need to meet my financial goals? It's also important to remember that it can take time for an investment to pay off. Patience is key when investing, and there may be periods of volatility or loss along the way. Keeping this in mind will help you make informed decisions that are right for your individual needs. Additionally, having a diversified portfolio and rebalancing your investments regularly can help ensure that you have a good mix of assets that can withstand different types of market conditions. That's all for today's video. Thanks for watching. If you found this video helpful, be sure to hit the subscribe button and click the bell icon to be notified when we post new content. Don't forget to check out our other videos on personal finance and investing. And remember, always do your research and invest wisely. See you in the next one.